Hello, everyone. Thanks for taking time to attend today's presentation. Today's webinar, ASAP Accounting and Payroll, is pleased to present resources that will hopefully give you some insight and make more informed decisions. And specifically, today's topic is actually part of a webinar series focused on raising the bar on employee benefits. And a big component of benefits is health insurance. So we're here to kind of unpack that into a few different webinar chapters to give you insight into this ever-changing and often confusing area. Real quickly, some information about ASAP Accounting and Payroll. ASAP started in 1990 in Telluride, Colorado, and we now have 3 regional offices, Telluride, Durango, and Denver, and assist clients with payroll processing and bookkeeping services. At ASAP, it's our aim to make business as simple as possible, really with the goal of getting you back to doing what you love. And with that, I'm going to introduce you to today's presenter, and I'm excited to introduce you to Dan Fallon, the President and CEO of the Benefit Group. The Benefit Group is an employee benefit consulting firm that delivers short-term and long-term welfare solutions and health solutions for employers nationwide. They're a Colorado-based firm located in Denver and have a very similar mindset to ASAP in terms of their consultative relationship with their clients. Their approach with each client relies on an acute understanding of the challenges that employers and employees face every day, and they use this experience to develop short and long-term strategies unique to each employer.
Thank you, Diana. Appreciate the introduction. Pleasure to be here. And what we're going to talk about today is an alternative to small group fully insured health plans in Colorado. So hopefully this will be educational and informing for you. And hopefully you'll be able to take something and bring it back to your business and benefit from it. So the agenda today is we're going to walk through the different types of health plan funding, go through the health plan components of how premium is built, because it helps to understand that when we talk about the alternative funding methods. And specifically, we're going to compare fully insured small group with level funding, which is a newer product over the last few years available here in Colorado, and it's gaining a lot of traction. We'll go through the underwriting and the advantages and disadvantages of the product as compared to fully insured. Now, before we get started, it helps to have a quick history of how we got to where we are right now. So the ACA became law of the land in 2014, and prior to that, insurance companies were able to rate on a lot of different aspects of your business. They've always rated on the demographics, the age of your employees. They also rated on the zip code, but they were also allowed to rate on a health sliding scale. So if you remember about 5-6 years ago, employees had to fill out health questionnaires for group health insurance. And then the insurance carriers would take that data back and they would assign a rating level, 1 being neutral, and it could go up as high as 1.1 and as low as 0.7. So there was a large swing, about a 40% swing, depending on the health of your group that went into small group rating. When the ACA came around, that was all eliminated. We went to what's called a community rating model, and it was all just based on age and location. So it removed the health rating. It removed the SIC rating or the industry rating. Some industries used to be rated higher or lower, depending on their risk. So what that left was just age and area, the area that you lived in. And what we saw was large rate increases statewide in 2014, 15, and 16. They tended to level out in 2016, 17, 18 in the front range, but continued to increase in the mountain areas. One of the other advents of the ACA here in Colorado was there was a bill change that eliminated a load to self-funded premium. And how that worked was, prior to the ACA, there was an insurance company, or insurance companies were allowed to load your rates by 35% if you went from a small group fully insured model to a self-funded model. And if you went back to a fully insured model, they were allowed to load you 35%. So it was extremely risky to go self-funding prior to the ACA. Well, that changed. The Congress here in the state of Colorado removed that 35% load. So now insurance companies were not allowed to load you if you went back to fully insured. And there was one carrier in the market that was actually poised to take advantage of that at the time. And it was the old Great West product, which turned into Cigna. They had a partially self-funded product, and that product was built to cherry pick good risk from the fully insured pool and hand better rates to those groups that were running well. But that product was really built for larger groups. So that's how the level funded product came about. Cigna invented the level funding product, and now all the core carriers in Colorado have it. So that's why we have this level funded product right now. And what we're going to do is talk about what it is, how it works, and if you have any questions at the end, happy to answer. So there's 4 types of health plan funding. There's fully insured, which I think most people are accustomed to. That is what you have right now. That's community rated. You pay a set premium. There's level funded, which is really a hybrid contract. It's part fully insured and it's part self-funded. Then there's partial self-funding. When you hear people talk about self-funding, they're pretty much always talking about partial self-funding. There's always an underlying insurance contract in that contract with the insurance company that mitigates your losses if you were to run bad. But those types of contracts are more pay-as-you-go type contracts and really more fitted for larger employers. And then there's ASO funding. ASO funding is really pure self-funding. So only very large companies that can actually assume all health risk, and you don't see it very often, but we'll have an ASO contract. All right, so we're going to talk about the different types of health plan funding. First is fully insured, which most people are accustomed to. It's offered to 2 to 99 employee groups, so employers that have 2 to 99 employees. It is community rated based on location. So what that means is, it doesn't matter if you are a software company or a mining company, you are given the same rates if you're in the same geographic location. The insurance carrier assumes all claims risk. You pay them a fixed premium every month, and it doesn't matter whether you spend $1 million in claims or $100 in claims over the year. That risk is assumed by the insurance carrier. When you get your renewal, it is calculated on the insurance carrier profitability for that rating area. So again, doesn't matter how good or bad you're run, and those rates are 100% pooled. There is protection in that 100% pooling rate. The premiums are subject to a premium tax, and these contracts are subject to the federal medical loss ratio that came about as part of the ACA. And that dictates that insurance carriers must spend at least 80% of the dollars that they take from you in premium on claims. 20% can be spent on expenses. There's also mandatory benefits such as pediatric, dental, and vision that cannot be removed. When you look at a level funded contract, the rating size is a little different. Level funding is a self-funded contract, and it's not subject to all state rules that the fully insured contracts are. So when the carriers offer it to 10 plus enrolled, some carriers will go a little less. And starting in 2019, because of the success of this product in general, the carriers are starting to open it up to groups over 100 as well. The rates are based on your demographics, claims experience, and the plan design. You pay a fixed premium. So that's why when we reference a hybrid contract, just like a fully insured contract, you pay a fixed premium every month. So you know your exposure in terms of health risk. However, that contract is partially self-funded. So there is a reward at the end if you do run well. And we'll get into that piece when we get into the workings of the level funding contract. The renewals are calculated on pooled experience and your company's utilization. So you actually get credit when you run well, and you have an underlying fixed premium contract when you run poorly. So it is really kind of the best of both worlds. The premium taxes are lower because they're not subject to the same taxes as fully insured plans. They are not subject to the mandatory benefits. So pediatric and dental and vision that are loaded into fully insured contracts, and you have to take those benefits, they are excluded from these self-funded contracts. They are subject to the ACA mandatory benefits. So you do get all of the same coverage as health insurance used to provide prior to 2014. There are still no pre-X's. So the pre-exit is the law of the land, and none of these plans have pre-existing condition limitations, so your employees are protected there. But they're also not subject to that medical loss ratio. So they don't have to refund premium dollars if they use less than 80% of the dollars they take from you for premium on claims. And that's important, because if you give an insurance company a goal that says, hey, if you can work a product very efficiently, you get to keep the profits. Well, guess what? They invented a product that they can do that with. And hopefully it's a win-win scenario for everyone. The other two types of funding we're not going to spend much time on because they're for larger employers. Partial self-funding, again, the rates are based on demographics, claims experience, and plan design. It's more of a pay-as-you-go contract with an underlying stop-loss insurance limit, and there's a lot of different levers you can pull. Now, the reason why we're not going to talk about those is there's a lot less bundled insurance arrangements that provide those for groups under 100 employees. And by bundled, I mean when you have a Cigna and Anthem and Aetna, they are the claims administrator, they're the insurance carrier, they're the benefit manager for pharmacy, and they provide the network. When you have a partially self-funded product, you oftentimes have to piece those pieces together to build your health plan. And there are very few bundled products other than level funded products available to groups under 100 employees. The renewals on these products are calculated less on pooled experience and a lot more on your utilization. So the rating fluctuation is pretty wild from year to year depending on how you run. So that's why it's better to have a much larger group that is fully underwritten and fully credible in an underwriting perspective with this type of contract. The taxes and mandatory benefits are the same as the level funding. They are less imposed. ASO funding, again, we touched on that. Only very large companies that can assume all claims risk have an ASO contract. So what is funding? Funding, we'd like to use analogies because it makes it easier to understand, and we can drop the insurance terms for a bit. So fully insured premium is kind of like paying for cable. You pay for it, and I know there's Netflix and Hulu and all that kind of stuff, but it's the same concept. You pay for Netflix, and they don't care how much you watch it. You're going to get charged a fixed premium. Whereas self-funding is more like your electric bill. When the lights are on, when the AC is running, you're going to pay for it. If you're not using the electric bill, you're not going to pay for it. So there's a lot more controllables in that scenario. So level funding, what it does is it blends the best of these two concepts together. You have a fixed premium, and you have some controllables that we're going to talk about that you can play with and hopefully win or generate lower rates and refunds based on how you and your employees use care. It's a middle road. So when you look at these funding options, people ask, what's the risk? It sounds, anytime you talk about funding, what is the risk to me? And obviously there's a risk-reward spectrum in insurance, just like anything else. Fully insured, there's virtually no risk. You pay a fixed premium. It doesn't matter how many claims you and your employees submit to the insurance company or how often you go to the doctor, you're going to pay the same premium and get the renewal based on your geographic location. On the other end of the spectrum, you have self-funding, meaning if you use a lot of care and you have a lot of high dollar claims, you're going to pay a ton of money. Right in the middle is the blend between where you have a fixed monthly cost, yet you have a participating contract. And we'll get into what participating means. But half of all small group policies sold in 2018 were level funded this year. So hopefully that speaks to the popularity and the fact that these plans are actually making sense. So how does the contract work? So in order to explain how the contract works, it helps to understand how any health insurance contract works. So this pie is pretty simple. It's broken into 3 different sections. You have your claims, which is the largest section, and this is your premium pie. So when you pay the insurance company premium, part of it is set aside to pay claims. Part of it is set aside for reserves, and that's the differential between what they expect your claims to be based on your demographics and the premium set aside to cover it. So that's their margin or their reserves. The fixed costs are just operating expenses. Also, commission is included in there. When you look at how a fully insured funding compares to a level funded contract, for fully insured, you pay a set premium. You don't get to see what's fixed and reserved. You don't get to participate in the contract at all. And then you just wait for your renewal to come and, hopefully the carrier is profitable. With a level funded contract, again, here's where the hybrid comes in. You pay a set premium per month based on your plan design and the number of employees. However, what the carrier does is set aside a claims fund. So they set aside a claims fund, and then if your claims are less than what they set aside, you get a credit or a refund of, now there's a bunch of different options depending on the option you select or the carrier you select, but you can get 50, 2/3, or 100% of the unused claim funding back at the end of the year. So that's what it means to participate in the contract. So there's no participation in a fully insured contract, but there is a participation in a level funded contract because you are incented to win. You're on the hook with the insurance company, and if you run well, they will give you a portion or all of that back depending on the contract. So how does it exactly work? The employer pays a preset level payment, which is just your premium each month, okay? And they pay that, those rates are locked in for 12 months, just like a fully insured contract. Unlike fully insured, there's no age-banded rating. So these are 4-tier composite rates, meaning if you enroll as an employee only and you're 25 years old, you're going to get the same rate as a 64-year-old that enrolls as an employee only, etc. Now, in fully insured rating, you can get composite rates, which are 4-tier composite rates, but they're based on your age band rating and can change from year to year depending on hiring. Now, level funding, part of the rating and level funding is your age and demographics, but there is no age banding underlying those composite rates. The employer and the broker can view your monthly claims reporting and assess that claims reporting throughout the year. So now there is transparency. So where in a fully insured contract, you don't know how you're running during the year. You don't know how you're running during the year. You don't know why your claims are what they are. Every month with a level funded contract, you have access to the claims funding number, and you have access to the actual claims that are being used. So you can actually see that and trend that over the year. In month 15, now month 15 is general. Some carriers do it in month 14, some in month 16. But at the end of the plan year, they do a reconciliation and they look at what they set aside in claims and how many actual claim dollars came through. And if you have a surplus, which means your claims are less than what they set aside, your claims funding, you'll get a credit in billed premium for the following month. So there's a pretty simple example here, and we made the math easy. If your annual premium is $300,000, annual premium is $300,000, and the fixed and reserves that we showed in that pie chart on the previous slide are $100,000. That's what you're locked into paying. You can't affect that piece. That leaves $200,000 in claims funding. So the insurance company set aside a $200,000 claims fund annually, and that's based on how many people enroll. Your actual claims are $160,000 for that year, so you ran pretty well. There's a $40,000 surplus left in that claims fund. Now, depending on the contract that you selected with the level funded carrier, they will give you 50% of that, 2/3 of that, or 100% of that $40,000 in a credit towards your next month's premium. Now, that 15-month number is pretty important because you don't get to month 15 unless you renew the contract. So there is a hook there. Most of these level funded carriers, if you're running well, in order to get that credit, you have to renew with them. But in theory, if you're running well, you're probably going to renew with them. So that's the hook that keeps you coming year after year. Now, if you ran extremely poorly, there wouldn't be a surplus, and then we'll talk about that later in terms of disadvantages. Now, if you have a deficit, meaning your claims are greater than the claims funding, there's no action or payment needed on your side. So that is covered by the insurance contract. You're paying a fixed monthly premium, and the insurance carrier is assuming all risk above that claims funding. So that's why it's a hybrid product, kind of the best of both worlds. Now, what is the catch? It does sound kind of too good to be true. You pay a premium, the insurance carrier's on the hook. If you do well, you win. If you do bad, they cover all the claims. So it is an underwritten product. Okay, so every carrier has slightly different guidelines and features, but these products are built to cherry pick the risk. They're not subject to state underwriting rules, meaning this is not community rating. So they're going to rate you kind of like it was rated 6-7 years ago on actual employee health. Some carriers will go down to 5. We recommend that you start level funding if you have 10 enrolled. However, if you are a smaller group, they'll do what's called an IMQ, or an individual medical questionnaire. And this used to be just how small group insurance used to be rated, but it's gone by the wayside with the ACA. So if you're under 15 to 20 enrolled, oftentimes the carriers will make each employee fill out an individual medical questionnaire, and that has 10 to 15 medical questions, yeses or no based on conditions, prescription drugs, height and weight, those sorts of things. And from those individual medical questionnaires, they can straight up just decline taking you on as a client. They can raise the rates that they initially gave you if you ask for what's called a street quote. But the IMQ is how they finalize rating before you start your plan year. Now, if you're a little bit larger group, usually 20 plus, they have what's called a group RX underwriting, or GRX is what it's called. And what we do is you submit a census, and from name and date of birth, they can actually track down what pharmaceutical data your company is using. And I know that sounds kind of scary, but all our data is for sale, and they can match up prescription drugs with limited census data. And again, they can either decide to decline your group, or they can issue you a rate. So the products are much more strictly underwritten up front. Once you qualify and they issue you final ratings, then those rates are locked in for 12 months, and everything we just talked about does apply. So it is crucial when you're entertaining a level funded quote that your census is dialed, that you have accurate quoting, because the underwriting can come back and get you right before you go to enroll. The underwriting methodology for a lot of these carriers is a little different. Some carriers will actually re-rate if you bring on an undisclosed employee. So say you bid out with a certain census that has 20 employees on it. At open enrollment time, you have 21 employees. We forgot about the one employee that is eligible, and that one employee happens to have a chronic condition. Maybe they have MS, maybe they have a multi-$1,000 RX prescription each month. That can affect your rates negatively. They can pull the quote completely. New hires, between an initial quote and open enrollment, if you hire new hires, some carriers will say, hey, that's okay, as long as we don't have a 10% census change or more will honor the rates. Some of these carriers listed below on their level funded products will make each one fill out an IMQ. So the underwriting is fairly stringent, but is it worth it? Yes. The rates often can be 20 to 25% lower than fully insured rates. And if you qualify and if you can lock them down, then you're in a participating contract. And we'll go through the advantages on a participating contract here in the next slide. But it's good to know what you're entering, what type of contract you're entering before you get into it and how it's underwritten. So what are the ideal types of employers that can benefit from a level funded contract? So if you have an employer that is relatively young and healthy, and when I say relatively young and healthy, you don't have to be all 25-year-old single males. As long as they're not very expensive, ongoing chronic conditions, you're usually a decent candidate to at least look and be rated on for level funding. If you want greater control and flexibility, there's a lot of different levers you can pull within a level funded contract to affect rates from year to year. If you have employees in different markets, in different areas of the country, in different markets here in Colorado, they provide a PPO type arrangement. Most of these products are PPO products, and you can provide a consistent level of benefits to all of your employees rather than having to have multiple plans in multiple locations. If you want to participate in the health and wellness of your members, so now it puts some teeth into health and wellness programs because you're all in it together. We'll talk about that in a bit. If you're accustomed to fully insured and you need predictable premium over the next 12 months, this is a great bridge between full self-funding, partial self-funding, and a fully insured contract. So the advantages are that you can now participate in the risk with very little downside. Because of that law change where they removed that 35% load in 2014, if you were on a self-funded contract and you went back to fully insured, there's really very little downside to a level funded contract if you qualify. It aligns your financial incentives for wellness and good healthcare decisions. So you have lower claims, that equals a bigger refund. Bigger refund equals a lower premium for employer and employee. So now all your financial incentives are in line. And what's more is, and even more powerful, is these level funded carriers provide the reporting and transparency you need and your broker or consultant needs to help you manage your plan more effectively. Fully insured carriers are a black hole. Under 100 employees, they won't release any claims experience. They won't release any utilization data. You get a renewal based on their profitability. With a level funded contract, you have the premium components broken out for you. You get to see what the reserves are, what the margin is, what the claims funding is before you enter the contract. And then during the year, you get data on physician visits, emergency room, how much these things cost, prescription drugs that people are taking, and you can try to mitigate any negative health trends as they're happening or before they happen. Now, all the data that you receive, it is de-identified, okay? So you don't know who's doing what, but you do get aggregate data on utilization, and what helps is they compare it against a national norm. So you can see if your group is running, do our folks use emergency room more than most groups? Do they go to the doctor? Are they getting their preventative visits? Or do we have a prescription drug problem? Or do we have an opioid problem or depression, et cetera? So you can put your time and effort into health and wellness and taking advantage of carrier tools that help you do that when you have that data. With a fully insured contract, you're in a black hole and you get no data. So it really puts teeth into the education and utilization part of a health plan. So all the carriers have cost estimator tools now. They didn't exist really 5 years ago, but you can log on to any one of these carriers that offers a level funded product, and you can type in MRI, and they will bring up a list of places to get an MRI and the general pricing from each place. So you can see that MRI at a hospital, maybe $1,000 to $2,000 depending on the hospital. An MRI at a freestanding imaging clinic may be $750. So when all the financial incentives are aligned for employers, employees, with the health plan, these tools that help employees save money can also help the health plan save money. Virtual medicine is all the rage these days. The stat is that 70% of all medical utilization could be handled on your phone, which is kind of scary. But, when you think of strep throat, pink eye, a rash, the flu, those are all easily diagnosed medical conditions that, you go to an urgent care center, you go to the emergency room, you go to the closest physician, and all they do is tell you to go to the pharmacy. Well, you can do that all over the phone now. So, and those save employees time and money, and those become more effective on a self-funded plan. And lastly, you still have that pooling protection. So if you do run terribly, you have the protection of partial pooling. You are getting rated on more on how you use and how your company uses medical care, but there is an element of pooling. Carriers don't consider a group fully creditable, meaning they can't accurately predict what your utilization is going to be until you have 400 employees on the plan. So if you're less than 100 employees, your credibility rating, or the ability for their actuaries to predict where your claims will be next year, is very low. They are still pooling you with their block of business. So you still have that pooling protection. Now, there has to be disadvantages, obviously. Now, the biggest disadvantage, really, it's really not a disadvantage, it's just, can you qualify? So you're heavily underwritten up front. But once you get into this contract, the rating from year to year can fluctuate more than fully insured. There is protection when you are 100% pooled in a fully insured contract. Now, in a level funded contract, more of your claims come into play on your rating, because the insurance carrier is going to take a risk on your premium. So if you have a bad claims year and you get a large renewal increase, that would only happen if the claims are ongoing. If you have chronic conditions and the carrier knows that those chronic conditions aren't going anywhere, and they want to mitigate their losses as much as possible, you can see much larger than normal increases on a level funded product. So if you do get that renewal, your option are to bid out to other level funded carriers, or return to the fully insured market. So that risk level is fairly mitigated with that fully insured backdrop. There are ACA fees that are not covered with a self-funded contract. The fully insured carriers pay your ACA fees for you. In a self-funded contract, you have to pay that fee. The only self-funded fee left, there were a few when the ACA first came on board, but the only fee that is left is an annual fee, and right now it's $2.39 per insured member. So it is a very small fee, and that is annual. That includes dependents, though. So say you have 30 people on your plan and another 30 dependents, $2.39 times 60, you're still less than $100. So it's a small fee, but you do have to remember to pay that in the July following your plan year end. And then ACA reporting. So if you are a true ACA small group with less than 50 employees right now, the fully insured carriers actually file your ACA reporting for you. You don't have to do that. That burden is not on you. But as soon as you take yourself out of the fully insured risk pool, that burden becomes yours. And you have to file the 1094 and 1095 forms annually in the first quarter of every year. Now, if you're an ACA large group currently, meaning you have over 50 full-time equivalent employees, you have to do this anyway. So the additional reporting is not really that big of a burden. But if you are below 50, you would have to do that. And there are several avenues to complete those forms. And that's pretty much all we have. So I'd like to open it up for questions. I think a few came through while we were talking.
Yeah, absolutely. Thanks, Dan. That was very informative. And I'm actually going to loop in Mark Betts, our payroll director here, who's been monitoring the question and answer to kind of dive in with some questions and facilitate a discussion.
Great. Yeah, thanks, Dan. There are quite a few questions here. So, and just before I leave that last slide there, ASAP can help with the 1094s and 1095s if those are a new requirement. We're already performing those for our large employers who are required to file those. So, let's see here. One of the questions was kind of getting into HSAs and kind of understanding level funding in terms of what type of plan designs you would offer there, and are HSAs, high deductible plans and HSAs, part of that?
Sure, good question. So the fully insured market, anytime you're with a carrier in a fully insured market, they have a set amount of plan designs, either about 10 to about 50 offerings, and that's from a platinum style plan with lower copays and lower deductibles and lower out-of-pocket maxes, all the way to a catastrophic, high deductible health plan that maybe has a very large deductible and large out-of-pocket max. And those same types of plans are offered with a level funded contract. Some carriers in the level funding markets will let you design a plan completely. So you can play with every portion of the health plan, which is really quite novel if you've been in a fully insured contract, because in a fully insured contract you can only take what is offered. You have set plan designs. I'll take option A, option B, and maybe option D. In a self-funded arrangement, there are some carriers that have the same 10 to 50 plans to choose from, and there are some carriers that will let you just design one tailored to your group. So short answer, yes, they exist, and you'll have all the same plan options as you would under a fully insured arrangement.
Okay. Another question was regarding networks. This is coming from someone I know travels out of state quite often, like a lot of us on the Western Slope. And so they were concerned about it being locked into a small network group. Are these PPOs, HMOs? What kind of options are there?
Good question. So the level funded products at this time are primarily PPOs and EPOs. So PPOs are probably what you've been accustomed to. That is usually the carrier's largest network, and you can self-refer in that network, meaning you don't have to pick a physician. As long as they're in the network, and these are usually nationwide networks, you can then self-refer. An EPO is an exclusive provider organization. That is essentially the same thing as a PPO, and it usually has the same doctors and hospitals in it, but there are no out-of-network benefits. So, and that's just a cost-cutting measure. So an EPO would be, you want the same access that you get with a PPO, but if the option of going out of network is not there, you usually receive, a 2 to 10% break in premium based on that eliminating that out-of-network option. So that the provider access is there with the level funded product.
Okay. One question's coming in on how you would look at your slides talked about number of employees in terms of 10 plus counts for these level funded plans. Is that number of employees, or is that number of enrolled participants, including dependents, is the question. Would you count the dependents and the employees enrolled, or is it just employees enrolled?
With most of the numbers on those slides, they are employee referenced or employee based. So when we say 10 enrolled, some carriers need 10 employees enrolled, exclusive of how many dependents enrolled. They would like 10 on the plan in order to initiate the contract. Some carriers will go down to 5, but anytime you see a number range, it is always referencing the employee being enrolled.
And this is a question for me, but control groups, how do they look at those, and how tightly in terms of, we have quite a few clients that have, multiple entities, multiple kind of varying types, whether it be multiple restaurants or something more complex, multiple investments that they're involved in, that they're the, lead shareholder of, that they have, different managers that they want.
Sure.
Each manager at all these different, locations, but they're all under different EINs. How do they look at control groups?
Okay, so the control group rules apply very similarly to self-funded contracts as they do to fully insured contracts, meaning if you are an IRS control group, you can bind together for coverage. Now, self-funded contracts do have an additional set of regulations they have to comply with. It's Section 105H of the IRS code, and those regulations are pretty strict. When self-funded contracts were invented, the government wanted to make sure that they weren't invented just for high earners and key employees. So unlike fully insured arrangements now, self-funded arrangements, there can be no discrimination with the employers that are allowed to bind together or the employees that are allowed to purchase coverage. Meaning when you have a self-funded contract, every employee that is eligible to participate has to be offered the same level of benefit and the same pricing. So that's from rank and file through management. So that is something that you definitely want to work through if you have a fully insured arrangement right now that may be a carve out or may be a stratified classing situation where management has 100% paid and rank and file have 50% paid. Well, however it's set up, those are often deemed discriminatory under a self-funded plan, and the fines are fairly large, and the benefits could become taxable to that key employee group. So that is one noticeable difference to be aware of when going from fully insured to self-funded. Now, there's some ways around it, and depending on how many, depending on the classifications, we can talk about it. But in general, the discrimination is regulated against in a self-funded contract.
Okay. One other question is someone's trying to grapple with how these level funding plans can be priced lower if there's a refund. How is that? Can you get into that? I mean, because if there are lower premiums up front and there's a potential for a refund, is there just that much opportunity for savings? Or go ahead.
Right. I mean, the carriers right now are they put a lot of weight into their underwriting. So, they used to be able to underwrite. Then when the ACA came around, they weren't allowed to underwrite until these level funded products were allowed to participate in the small group market. And so you got to remember that they're out there trying to cherry pick risk. So they're going to underwrite you. They're going to look at every health question. They're going to look at those group RX or that GRX underwriting tool that identifies prescription drug uses on a group. And then they're going to blend that with what they know in your geographic area, and they're going to come up with a rate. And so we've had a lot of groups that don't qualify for it. They'll go through underwriting, and the carriers will say, "No, sorry, we won't issue a quote." We'll have some carriers issue a quote and others decline. But remember up front, they are underwriting you pretty stringently. So that's how there's that opportunity.
One other question here. Let's see here if I understand this. It's trying to understand what to do, if this is appropriate for them kind of question in terms of, looking at, should I look at this or not? What's let's say mid-year a chronic situation occurs, unfortunately, under this level funding, I mean, how can the employer know the maximum risk that could occur to them under these kind of things? Is there a way to see that, or did you go over that?
Sure. So remember that the premium that's billed to the employer is locked in for 12 months, just like a fully insured contract. So if something happens during the year, you're just going to continue paying your premium that was already agreed to and set upon in your contract. So there's no additional risk during that 12 months. The renewal, if you have a terrible claims year and you have some large ongoing conditions and the carrier doesn't want those conditions on their block, they can issue a large renewal. There's no state filed rates in this equation. So they could come back and say, hey, here's 25%, here's 30%, here's something larger. And then at that point, your options are these ongoing conditions? Will another level funded carrier look at us and give us, better numbers? Or, you still have the fully insured small group market to fall back on. So if you're on fully insured right now and you go level funding and it doesn't work out for you, you can go back to fully insured. So the downside, there really is no downside. You can always go back to what everyone else is paying in that fully insured market.
And then when you go back to fully insured, they don't look at your claims history from the level funding and when they price you. So.
Correct. The fully insured carriers file their rates with the states. Now they're the same carriers, that product segment is filed with the state and they can't be changed. And they're not, again, they're community rated, so they're only based on area. So you're gonna get the same rates as any other group in the area when you go back to fully insured. So in terms of, should employers be looking at this? I mean, I think if you have a healthy group, I think you should definitely look at it. If you're anywhere above, 15, 20 employees on the plan and you don't really know the health of your group because, a lot of that data is private, it's pretty easy to run quotes on it. The GRX quoting tool is non-invasive. They're going to do the underwriting without you knowing. Now, if you're a smaller group and have to fill out individual medical questionnaires, that's, where you got to make a decision. Hey, we got to go back to individual medical underwriting and we have to make the employees fill out these questions. You can do it in a HIPAA compliant private way that you don't know those. The employer doesn't know the health conditions, and the broker consultant can work with you on that.
Speaking of areas, last question, this is for me, but what are you seeing on the Western Slope in terms of carriers that are doing level funding? Because, region to region, our clients in these different areas is drastically different who they want to be with in terms of the groups of hospitals and doctors, from Telluride to Aspen to Durango. You can see different swings in the types of carriers. So.
Yeah, the networks are pretty slim on the Western Slope. However, a lot of the carriers still have the same providers and doctors available in their level funded products. And, Anthem has a level funded product that works out there. United can quote, Aetna can quote, Humana can quote, and Cigna can quote. So you have really the big five that can quote on the Western Slope, and you'll still have access to the same hospitals and providers that you have on a fully insured basis. So the options in the medical carriers are fairly similar. It just comes down to, can you qualify on a rate basis?
Thank you. Diana, has any come in since I've gone through these?
No, that looks like it's it. I did just want to give Dan an opportunity to tell us a little bit more about the benefit group and what are kind of your specialties and your approaches that you can share with our viewers here. I'd love to give you the stage for a minute.
Okay, thanks, Diane. Appreciate it. So we are a brokerage that deals with small to mid-sized groups, and that's where we focus. I started my career off at GE, and we focused on very large groups with setting up self-funding arrangements for them, and noticed that the small to mid-sized groups, often don't get the attention. They often don't get the service. They're often overlooked by large brokerages. So what we did when we set up our brokerage was we focused on that small employer segment. So really under 200 employees, 2 to 200 is our focus. And what we try to do is we try to bring the technology and expertise that you'd get in a large group setting to small groups. So when you work with us, everything's on the cloud. We put your benefits on the cloud. Open enrollment is on the cloud. It provides a platform to maximize your education and engagement with employees, because now they don't have to search through a 30-page packet to understand their benefits. And so what we try to do is work with employers that we can provide the most service to. Most of our employers don't have full-blown HR departments. So we take on a lot of that. We are there for you, and this is a niche that we found works really well for us. So that's about it.
Well,
Awesome.
with that
Well,
said, Diana, let me
ahead,
just
Mark.
ask a couple questions for the viewers out there. We work with the same clients, and that's why we've invited you here, and like which you can provide. How do people get started? There's data that we can get out of our payroll data for our clients. I just upfront, we're happy to do that, extract that data. But how would they get started setting an appointment, or should they start gathering their policies now? And what do you ask of as an initial step?
Sure. So the initial data gathering isn't too burdensome. What we need is a census, and I believe ASAP can put that together. And other than that, we'll need to know the carriers and the products that you're with now, and who is enrolled. And then we can model your current plan costs versus any of the options that are out there in the market. And we'll bid the fully insured options just so you can see them, and then we'll bid the level funded options as well. And then we can talk about the underwriting piece, which is, you know, if you're of a certain size, there wouldn't be any further underwriting. It's that Group RX tool. If you're small, there may be individual medical questionnaires required, and we can talk about how to best do that and roll that out to employees. So really the initial start, maybe contact ASAP, let them know you're interested, and if we can get the information from them, there'll just be a few other pieces of information we need on your current benefit plans, and then we can get started with quoting for you.
Thank you.
Yeah.
Thank you.
Thank you, Dan, so much. And thanks, Mark, for moderating the questions. And hope everyone has a wonderful day.